Welcome to Winning the Investment Game. My name is Adam Koo, and I believe you're listening to this because no matter where you are in your life right now, you know you're capable of achieving a lot more income, a lot more wealth, and a better life for yourself and for your family. And I'm sure you're listening to this because you want to learn the right strategies on how to bring your life to the next level financially. Well, today I'm going to show you in just 15 to 20 minutes simple ideas that can change your life financially. I'm going to show you ideas on how to achieve consistent profits as an investor and how do you build your wealth in a sustainable way and be financially free in the next 5 to 10 years. So if you just got 15 minutes, listen up, and these ideas will make a huge difference in your life. First, I come from Singapore, and I always say that Singapore is the easiest place in the world to become a millionaire, to become extremely wealthy, because of the tremendous opportunities in this country and the region around here. In fact, the Straits Times reported that 17% of Singaporeans are millionaires. That's the highest in the world. And not only that, but the number of millionaires in Singapore is to at least double by 2016. So the question is, how are millions created in the world today? The Business Times reported that it is the investment gains that it's creating many more millionaires. In fact, Forbes had a ranking of how to become a billionaire, and the top 10 ways to become a billionaire is ranked number 1, investments, ahead of technology. So again, whether you want to be a millionaire or billionaire, investments is the fastest way to do it. In 2013, Forbes also reported that Singaporeans are the fastest in the world to become millionaires. And it says over here, it takes most Singaporeans less than 10 years to become a millionaire. That is the fastest rate anywhere in the world, says a wealth report released by Barclays Bank July 5th, 2013. So how is this done? Again, it says this: while the popular belief is that the wealth of millionaires in Singapore has come from the dramatic rise in property prices over the years, that is only partly true. According to the survey, 72% of the wealth was made from personal investments. In other words, from the stock market especially. So that's how wealth is created. Now here's the bad news. Well, the number of millionaires are increasing everywhere in the world, but the number of poor people are also increasing. While the rich get richer, there are people who are getting poorer. And the question is why? Why are there people getting poorer in an age today where wealth is unlimited, where you can create wealth every single day? And the answer is because of financial ignorance. Many people out there, unfortunately, never invested the time to learn about how to manage their money, how to save, and how to invest, and how to build their wealth. So they're the ones suffering, and it's really, really unfortunate. So the greatest risk you can ever take is the risk of not learning how to manage your own money. And that is why 10 years ago, I created Wealth Academy, a school to teach people financial literacy, because I said, hey, if you can help more people create wealth, the world will be a better place. And since then, for the last 10 years, we have been to about 7 countries. We have trained over 5,000 people, and many of them today are professional fund managers. Many of them are financially free. So much so that in 2014, we were awarded by Share Investor the most preferred financial educator in Singapore and the region. So let's get started by learning some powerful ideas on how to invest. There are 4 keys to profitable investing. The first key is knowing what to buy, what to invest in. So obviously, what do you want to invest in? You only want to invest in the very best companies. Because when you buy a stock, you're really buying a company. And how do you know which is the best company to buy? Well, that's based on fundamental analysis, analyzing the fundamentals of the company. And we'll talk about it in a short while. Now, this only accounts for 20% of your success. Why? Another 10% is knowing how much to invest, how much to buy, how many shares do you buy. So this is really based on risk management and position sizing. 30% of your success is not just knowing what to buy or how much to buy, it's knowing exactly when to buy. It's all about timing, right? So there are people out there who say, you know, Adam, I bought a good company. Why is the price going up? Why am I losing money? And I said, because you bought the right stock by the wrong time, right? You must know exactly when to buy. And you only want to buy at that point when the price is going up. So you make money immediately. And that's based on understanding technical entry signals. And I'll talk about it in a short while. Now, you know what? There are people who know what to buy, when to buy, but they still don't make as much money as they can because they don't know when to sell. 40% of your success, the majority, is knowing when to exit your investment. And that again is based on technical exit signals. So let's explore in greater detail each of the steps. So again, the first step is knowing what to buy. Now, we only want to buy stocks of companies that are great performers. And there are many things we look at. For now, I'd like to just introduce one of the most important keys, where we only invest in companies that show consistently increasing sales revenue, net income, and cash flow from operations. Of course, there's many other things we look at, like conservative debt, like sustainable competitive advantage, like return on equity, like growth drivers, right? But for now, let's just focus on one of these things. Now, why is it so important for a company to perform consistently in growing its sales and net income? Take a look. You can see this company is known as General Motors, and over a period of 6 years, the profits or the earnings as shown in green is extremely inconsistent, making money some years and losing money some years. Now, when you invest in this kind of company, you can expect that the share price over time is going to be going down, because this is not a very good performing company. Now, on the other hand, if you look at a company like Johnson & Johnson, where during the same 6 years, going through the same recession, but despite that, the earnings or profits are increasing consistently. And these are the companies where you find over time their share price, although will go through volatility, but over time, the company will increase in value. Step 2 is knowing when to buy. And this accounts again for 30% of your success. So take a look at a company called UOB. And I would say UOB is a very good company, it's a very good bank in Singapore, right? And if you look at the intrinsic value of UOB, I would say it's roughly about $20. That's the intrinsic value. So we only buy when the price is undervalued and on an uptrend. The trouble with many value investors is they buy when the price is undervalued but on a downtrend. So what happens is, for example, the price goes from $20 to $17 and they think, hey, it's cheap, it's undervalued, and they buy. But what happens? That's right. On a downtrend, cheap becomes even cheaper. So $17, although cheap, goes to $9, even cheaper. Now, if it's a good company, you may say, I'm going to hold it until it gets back to my break-even price. So if you hold long enough in a good company, yes, eventually it's going to go back to its intrinsic value. But that took about 1 year to go back to break-even. So to me, that's really stupid, because you're not making money for 1 year. As a good investor, you should be making money every single year, regardless of the market condition. All right? So we never buy when the stock is on a downtrend. We only buy when the stock is on an uptrend. Now, how would you know where's the trend? Now, there are many ways to read trends. The simplest way I can show you right now is using two moving averages, the 50 and the 150-day moving average. Now, I'm not going to go into the complex theories about how it works. I do that in my live seminars. But for now, just remember this. When the 50 blue line is below the 150 green line, you never buy, because that is a signal of a downtrend. And on a downtrend, the momentum is going down. You only want to buy when the 50 blue line is above the 150 green line. When you see that blue line crossing that green line, that is an uptrend signal. So that is the time we buy, somewhere over here at $14. So again, we never know where the bottom is, and you can, never buy the bottom. But we don't need to buy the bottom. As long as we buy on the way up, that's good enough. So you buy at $14, which is undervalued because the intrinsic value is $20, plus it's on an uptrend. So the moment you buy, what happens? You start making money immediately. You're not wasting your time on a downtrend. All right? And that's a 42% return in 1 year, when someone who have bought maybe over here had to wait 1 year just to break even or make a paltry 10%. 40% of your success is knowing when to sell. So when do we sell? Well, we sell when the stock price goes back into a downtrend, because what goes up will come down. So take a look at this example over here. You can see this is a stock known as OSIM, and it goes on an uptrend, downtrend, uptrend, downtrend, uptrend. It's known as a very cyclical stock. So again, imagine if you bought the stock over here at 50 cents. You may have been very happy as it went to $2. But if you did not know how to sell and when to sell, it went back down to 50 cents again. And worse still, it went down all the way to 1 cent. In fact, if you bought over here after 1, 2, 3, 4, 6 years, you may have seen your money drop by 90% after 6 years, even though it did go up because you did not know when to sell. So how do you know when's the downtrend? Again, there are many ways of reading trends, but for now, I'm going to teach you a very simple kindergarten technique, again, using the 50-150 blue and green lines. So like I said earlier before, when the 50 crosses above the 150, that is an uptrend signal. That's when you buy. Remember that? But the moment the 50 crosses below the 150, you have to sell, right? So buying over there and selling over there gives you a very good return. Now you may say, hey, why couldn't I have sold at the top? Again, you never know where's the top. So don't be greedy. As long as you sell, before the majority of the downtrend, you're doing pretty well. Okay? You're already making 175% in just 2 years. Okay? Versus someone who bought over here and after 4 years is losing half their money, right? If they did not know how to sell. And once you sell, let the stock crash all the way down. And the moment you see a new uptrend pattern over here, when the 50 crosses above the 150, you can buy it back at 20 cents over here. And as you buy it back, that's right, you ride the new trend all the way up and again get out over there when the trend reverses down, clocking another 800%. So it's so important to know when to sell. Now, the next step is knowing how much to buy. This accounts for 10% of your success. Calculate how many shares to buy when we make an investment. Well, here are the steps very quickly. The first thing to understand is that when you invest in a stock, you always risk a fixed percentage of your capital at each time. And you should only risk a small percentage of your capital. For example, 2% and not more. Okay? Step 2. Always place a stop loss for every investment. Because no matter how good an investment, there's no such thing as a sure win investment. Things can go wrong. If it goes wrong, you have to get out. And the best way to get out is to have an automated stop loss to sell at a certain price that you predetermine. And once you set your stop loss, you can calculate your risk per share. Step 3 is to calculate the number of shares to buy using this formula. Your percentage risk per trade, which in this case is 2%, multiplied by your total capital that you have. For example, $10,000 or 100,000 or 1 million, doesn't matter, right? Divided by your risk per share. So let me give you an example of how to use this formula. This is a stock called Goodpack, and you can see that it was on a downtrend and now reversing into a new uptrend, and that's when we want to buy, right? We buy when it goes into a new uptrend, when it's undervalued. So let's imagine when the 50 crosses the 150, you decide to buy, and the price is now at $1. Then you decide to put your stop loss at about 80 cents, somewhere below the previous low of the stock price. Okay? Now, next we have to have a rough profit target. Where do you think the price is going to go? I would guess about $2.30. So why $2.30? Because this is where there's a strong resistance level. You can see the price was not able to break this level, means there were a lot of sellers over here. So we intelligently put a profit target of $2.30. Now it doesn't mean that at $2.30 we will sell. It doesn't mean that. If it goes higher, we will keep holding it. We only sell when the price reverses into a downtrend. But intelligently, we know that you'll reach at least $2.30. All right? Next, we calculate our risk per share. Our risk per share is 20 cents. Why? Because we buy at $1. The worst that can happen is it drops to 80 cents and we sell. So we lose 20 cents per share. So every share we buy, we are risking 20 cents. Now, for every share we buy, we have the potential of making $1.30 if it goes to the resistance level. So we are risking 20 cents to make 130. Our risk to return ratio is to 1:6. Now, we only take an investment if the risk to return ratio is at least 1:2 or better. So in this case, 1:6 passes that. Next, we calculate the number of shares to buy. So again, remember this formula. We take our risk per investment, which is 2%, multiplied by our total capital. So let's imagine the total capital that you have is $10,000. So 2% times 10,000 is $200, which means the most you can ever lose investing in Goodpack is $200. But each share you buy, you're risking 20 cents. So you take $200, divide by 20 cents, you get 1,000 shares. So now you know how many shares to buy. You buy 1,000 shares. And each share you pay $1, right? So in other words, your investment is $1,000, but your risk is only $200 because of your stop loss. Do you understand? Great. So in other words, if the stock hits your stop loss, you lose 2% of your capital, which represents $200. If the stock hits your minimum profit target, you make, that's right, 6 times 2%. You make 12% return. All right, you're risking 2% to make 12%. Now, once you buy Goodpack, could you buy another stock? Sure, you can buy a second stock. So let's say this time you decide to buy a US stock known as Yahoo. And Yahoo is going sideways in a consolidation pattern. And the moment it breaks out of the consolidation pattern, that is a strong indication that it's starting a new uptrend. This is another strategy that we teach at Wealth Academy. Buy the breakout from the consolidation. So you buy at $17 and you put a stop loss at, say, $15.50, which is just below the previous low again. This time, what is our risk per share? Our risk per share is $1.50. Because the worst that can happen is we sell at $15.50 if the stock price drops and we lose $1.50. Now, Yahoo doesn't have a resistance line. So how high can it go? Well, we have to calculate the intrinsic value of the stock, which you're going to learn in Wealth Academy. So the intrinsic value is roughly about $22. That's what Yahoo is worth based on its net tangible asset as well as its cash flow from operations. So in other words, if it reaches $22, which is the minimum it should reach, we make $5, right? 22 minus 17 is 5. So what's our risk to return ratio? Again, 1:3. This time it's 1:3. It's more than 1:2, we'll take it. So how many shares do we buy? Once again, we risk 2% of our capital. Assuming our capital is still $10,000, right? Because Goodpack has not gone up, it's not gone down, it's still $10,000. So 2% of 10,000 is, again, $200. So the most we can lose on Yahoo is $200. But each share we buy, we're risking $150. So $200 divided by 150 is 133 shares. So in other words, we buy 133 shares of Yahoo. And we risk, again, 2%. So if the stock hits our stop loss, we risk 2%. We lose 2%. If it hits our profit target, we make 3 times our risk, which means we make 6%, as you can see there. And let's imagine you buy another stock called OSIM, another stock called Apple. So you buy 4 stocks, and each stock you risk 2%, 2%. Your total risk is 8%. Okay, now what's your total return? Let's imagine in the case of OSIM and Apple, the risk to return ratio is only 1:2. Not as good as these two, but minimum. So if it reaches its profit target, minimum we make 12% for good bag, 6%, 4%, and 4%. Now, can we get it all right? Will we win 100% of the time? Of course not. There's no such thing. So we can never be right all the time, and we don't have to be right all the time. But I can tell you the secret of consistent profits is to be right just a bit more than you're wrong. And as long as you follow the rules of buying good companies on an uptrend and exiting at the right time, you can be right, I would say conservatively, 70% of the time. So let's imagine in a year you do 20 investments. And out of that, when you lose 2%. When you win more than 4%. But let's just put 4% as a minimum profit. So that's 14 wins and 6 losses. For my 6 losing investments, I lose 12% in total. For my 14 winning investments, I make 56% at the minimum profit. So what's my total profit, or net profit if you will? It's about 44% return a year. Now if you're doing 44% return a year and you compound that annually, you can be a millionaire very fast. Now you may say, hey, can I get more than 44% return a year? Of course you can. There are 2 ways to do it. Number 1 is you make more investments a year. You take more concurrent investments. Or you risk a higher percentage per investment, which I don't really recommend. In fact, the highest risk you should take is 3% at the maximum. Now, what if you can't get a 70% win rate? What if you only get it half right? Okay, now think about it. When you buy a stock, it either can go up or go down, right? So if it's purely by random chance, it's a 50% win rate if you flip a coin, all right? Now you should do a lot better than 50%, but if you were to only be as good as random chance, that means you get 10 wins and 10 losing investments. But when you lose 20%. When you win 40%. Because you control the risk per loss and ensure the risk to return is more than the risk. You still net 20% return a year, which to me really sucks, okay? But it's still not bad. That beats the fixed deposit rate, all right? Now, you can see that by following the methodology with discipline, you can achieve consistent profits every single year in the markets. In fact, in Wealth Academy, you're going to learn how to short sell the market as well. In other words, if the market goes down, you also make money, and we learn to hedge our investments. Just to share with you some of my students who I have the privilege of training for the last 10 years. Wei Ping is one of my very good friends now, and he's one of my most grateful students. Every time he goes on stage, and he always talks about how my training has helped him turn his life around. Wei Ping came about 10 years ago, one of my first students. He was an accountant then. He quit his job and subsequently became a full-time trader, investor, and now professional fund manager. And recently he was featured on the national newspapers. He started with $20,000 US and made about $1 million US in a couple of years. And now he's a full-time investor. He's financially free. Here's another email from Derek Koo, who is one of the senior remisiers in one of the stockbroking companies in Singapore. And he sent this to all his clients a couple of years ago. He said, in the last 2 years, I had the opportunity to work with the graduates from Adam Khoo's Wealth Academy program. Many of them knew nothing about the stock market or lost a lot of money on their previous portfolio prior to the course. I then witnessed how Adam's course on financial education changed the lives of people who learned and acted on his advice. They became more confident in the market and made good returns on their portfolios consistently. And Derek's not related to me, although he's got the same surname, but he's a really great stockbroker and I use him all the time. And it's also a great company that he works for. Here's another email from one of my students, Chow Yong. And he said, Dear Adam, I'm Chow Yong from Wealth Academy. Not sure if you remembered me. I was a very quiet student. I have a lot of praises with regards to the Wealth Academy course, and I've been recommending it to people around me who want to know more about investments. I would describe this course in a way that I've learned much more during my 4-day seminar than what I studied throughout the 3 years of pursuing my diploma in accountancy and finance. Well, thanks for that. Although I do not have a lot of money to invest right now, I can say that even with a few $1,000s, I'm still able to get an average return of 20% to 30% for the past 3 years. And this guy's an amateur with no financial background prior to my course. This is definitely better than putting my money in the bank and earning an interest of less than 1% a year. This is in Singapore. I'm proud to say that this year, 2013, has been a great year for me as my investment return is over 60% in the year alone. All right? So, if you want to learn more, come and achieve a financial freedom by building $1 million portfolio. It's a workshop that I run quite regularly. It's a 3-hour workshop. You're going to learn about the psychology of successful investors, how to start planning your financial freedom today, how anyone can become a millionaire with the right investment strategies, how to profit from the current market crisis, the value momentum strategy of achieving consistent profits in today's markets, and how to identify and capitalize on market trends and turning points. Great part about this 3-hour workshop is complimentary for a limited period of time. Seats are very limited. Book your seat online today if you want to learn more. Take care. This is Adam Khoo signing off.